we learned that the government may be open to introducing new monetary policy instruments, and you are also picking up that the Finance Ministry and the Reserve Bank officials have discussed introducing the Standard Deposit Facility Scheme as a strong tool to suck out the surplus liquidity from the banking system. Is there any clarity on how they will go about doing that?
Well, the sense that we have gathered is the fact that the government may be open to the introduction of possibly new instruments in the monetary policy toolkit, and earlier on, way back in 2014, this was part of the recommendations made by the Ujit panel report on the operating framework of the monetary policy, how that can be strengthened further. Having said that, in terms of the special deposit facility, which is what is being spoken about, here we understand that Finance Ministry has asked for a formal proposal from the Reserve Bank of India on the same. And what the SDF will probably mean and do is the following. Basically, this could be an additional tool in the monetary policy toolkit for RBI to better manage liquidity. Also, it can be used as an instrument for sucking out excess liquidity. It will help further in RBI's efforts on sterilization, especially when the capital inflows are very high. Apart from this, the 2-point advantage that an SDF may enjoy is that no collateral will be required with this instrument. And plus also, the interest rate that will be offered on SDF, there is a proposal that possibly some kind of a remuneration should be given to banks who would come and deposit their excess liquidity with RBI under this window. Well, here the rate will not be linked to the benchmark policy rate. So that gives a lot of flexibility to the regulator in terms of better liquidity management. Of course, and this proposal will require an amendment to the RBI Act. How and when that happens, that will possibly after the formal proposal of RBI comes in at the Finance Ministry.